Joining us this afternoon, Ed Morse, Citi Global Head of Commodities Research. Ed, it is so good to talk to you. Such an important time because of the possibility of, I guess, as some put it on the street today, nonlinear increases in commodity costs. What you're thinking, given what we've learned in the past 24 hours?
Well, there's no doubt that commodities are tight and the oil market's as tight as any. On the other hand, it's really difficult to figure out what the impact is going to be of any level of escalation in the Ukraine crisis on oil. We don't see Western institutions, Western companies stopping their imports of either Russian oil or Russian gas. And we don't see Russia and Russian companies curtailing their exports of oil and natural gas. So our judgment is that unless something very strange happens, there won't be some sanctions that are put in place that will directly have any impact on oil and gas prices, and that will continue the march down that they already began before this last bit of the crisis came to hold.
So a few weeks ago, Citi, and I imagine it might have been your desk, said short December crude. We like this trade because we have high confidence in it. It's out of consensus, base forecast in the mid-60s. Does that still hold?
It very much still holds. We think that there's going to be an incredible amount of oil supply coming into the market this year, not the least of which is the U.S., where we think there'll be a good 1 million barrels a day of increased production between the beginning and the end of the year. And we don't see demand growing at the rate that it grew last year, which was largely a function of the recovery from the pandemic. So we're seeing a lot more oil coming into the market and a lot less demand growth than we've been used to, and all of that should spell, by the time we get into the second quarter, inventory growth rather than inventory withdrawals. And yes, inventories are tight at the moment, but the next few months looks like they're going to loosen up significantly.
Ed, it's Morgan. How does Iran factor into this? I mean, it does seem like the U.S. and allies are moving quickly to try and strike a nuclear agreement, a nuclear deal with Iran right now. How much hinges on that, where oil supply and the entire energy complex price outlook for you is concerned?
Well, it does have a big impact on the price outlook. It depends a little bit on how much you think Iran can put into the market. But the numbers indicate that they can add at least 1 million barrels a day to the market between now and the end of the year. They have an incredible amount of inventory floating on the seas around Iran and on land storage that can come into the market as soon as a deal is struck. We think that we'll see a 500,000 barrel a day increase in Iranian production before May and June. If a deal is struck in the next couple of weeks, and then another 500,000 barrels a day by the end of the year. I would note that the call we had on shorting the market for the end of the year was not based on any Iranian crude coming into the market, and we now see an increment beginning to the end of the year of about 1 million barrels a day.
Meantime, gold is rallying. It's at a multi-month high right now. Does it have further to run at this level, given the fact that we do have this uncertain geopolitical backdrop, and then, of course, we have a Fed tightening?
Yeah, well, gold is certainly, a hedge against risk. And when we have moments like this moment, we always see gold rising. But look how flat it's been. It has not really risen to the levels it's been at. We think that the rate increases that we're going to see in the United States are going to see a significant increase in the value of the U.S. dollar against other currencies. That is much more appealing as an interest-bearing asset than what one would get by hoarding gold. So we think gold has potentially a little bit more to go, but we're looking for more downward pressure as we get past this crisis.
Hey, finally, Ed, we're likely to read more stories about the White House mulling XYZ, gas tax holidays, SPR releases. Do you take any of those seriously?
I think you have to. I mean, the White House is concerned about gasoline prices. They've been concerned about them since last September and October, when they were trying to put pressure on the OPEC plus countries to accelerate their return to the market. They did have several SPR releases. Those came about at a time when the market got exceptionally tighter, more tight than people had thought it would be. We had outages in places like Libya and Ecuador that took oil off the market. We had higher demand because the COVID pandemic was not as bad as people thought. We had higher demand because winter was colder than people thought it was going to be. And we had higher demand because of what happened to natural gas prices that caused there to be fuel switching to propane and to diesel for power generation purposes. We think that increase in demand is going to come off. And with it, we don't, if there are no more supply interruptions, we're going to see significant easing on the market. So it's up to the White House to get the timing right.
Ed Morse, great to get your take today. Thanks for joining us.